We're schizophrenic about it. So I'll let the bullish view be explained, and then I'll explain the bearish view.
I mean, we have an exposure in gold and silver, and we have for a long period of time. We view it as like an insurance policy, and against some of the stuff we're talking about tonight. It's something that you want to have a measured amount in your portfolio. But if things play out a certain way, it's hedging you against certain scenarios. And so we're comfortable holding that, and it has gone up a lot. We talk internally about how we want to deal with that and how we want to trim it. But, and we are doing that selectively in certain cases. But, it is an asset class that we still like. If tomorrow we come in the morning and there's an agreement in Washington and they're cutting entitlement spending, I might reconsider some of that. I mean, I would become a little bit more comfortable with what's happening with the U.S. dollar, and I think I probably would trim that position a bit.
Yeah, it's interesting. We published a newsletter last year, and I had just got back from a trip to South Africa, and we'd spent some time in Zimbabwe, which I had these notes from Zimbabwe. They were $100 trillion notes, and if you had 5 of them, you could buy a cup of coffee, right? So it was sort of this cautionary tale about printed money and hyperinflation, all the rest of those things. But I decided to do some research into what happens when countries have inflation but are going to honor their debts. So I went back and took a look at the last century has been the most inflationary century in human history. And if you took a look, and I took a look at 3 currencies, the Canadian dollar, the US dollar, and the British pound. And if you had a British pound in 1914, today the inflation rate on that pound has 8,600% since then. In other words, it's basically worth about a penny in that time frame. And then if you took a look at an American dollar, Canadian dollar, they're worth about 4 cents. Their inflation rate has been 2,500%. So nothing like this has occurred in human history. In the same century, the price of gold has gone from $20 an ounce to $1,400. So it's proof that gold is a perfect inflation hedge, and then some. But if I took the $20 that the gold was an ounce, if I simply bought $20 worth of government bonds, UK bonds, American bonds, and Canadian bonds, and just left them sit, let the interest compound that was paid on those bonds over each year for the last almost 100 years, while gold is at $1,400, those UK bonds would be worth about $1,900 today. The American bonds would be worth about $2,400, and the Canadian bonds would be worth $4,500. And that's all paper. So the point is, to me, if in the most inflationary century in human history, gold cannot simply outperform paper money with interest, then I don't look at it as a strategic asset. It's not generating cash flow. I look at it, as Rob says, as an insurance asset. So I buy this because a catastrophe might happen. But I don't buy it because I actually think I'm going to get a superior long-term rate of return, because I don't. And the evidence doesn't seem to support that either.
Sorry.
I think that's even less of an argument. I think silver is unlike gold, silver is not a store of value. It has a major industrial use, and its performance to a large degree depends on that industrial use existing, whereas gold is just there as a store of value and for no other reason. So if I was playing the precious metals game, I think it's a bigger gamble on silver than it is on gold.
Though I would say that it's not acting like that right now. It's acting, what's moving silver up is not the industrial demand, it's the investment demand. Yeah. And the fact that there's less of it, and thus it could go up.
But people forget back in 1980 that the Hunt brothers, the silver market, and they say, yeah, well, silver's only whatever, silver is like 40 times, 40 ounces of silver for every ounce of gold or whatever it is currently at. Well, back in, when the Hunts really cornered the marketplace, silver got to 17-to-1 ratio. And then, of course, it just completely disconnected. One other cautionary issue to think about for every asset class, this is true. Anytime an asset class rises several hundred% over a relatively short period of time, and that rise is far faster, and you saw what happened in housing, you've seen what's happened in the stock market in the dot-com boom in the 90s, well, the price of gold has gone up 500%, and the price of silver has probably gone up 1,000% in the last 10 or 11 years. So when you're deciding to buy an investment on a probability basis alone, you would look at something and say, what do I think the upside is going forward on something that's already risen 5 or 10 times? Right, and that's also part of the equation as well.